Welcome back to Beyond the Ledger, where we go beyond the numbers to explore the strategies, risks, and opportunities shaping today's business landscape. I'm your host, Shardae Layfield. When it comes to tax incentives like cost segregation and R&D credits, most companies assume they're maximizing value. But in reality, the biggest risk often isn't what you're claiming. It's how those claims are being built, supported, and integrated into your broader tax strategy. Today's conversation gets into the real differences behind the providers companies rely on, from boutique to full-service public accounting firms, and where those differences can either create opportunity or expose risk. We'll unpack what actually makes a study defensible, where companies tend to leave money on the table, and how increased IRS scrutiny is reshaping the way businesses should approach these incentives altogether. Joining us today is Duwayne Sibley, a director at Bennett Thrasher and a leader in the firm's cost segregation practice, driving cash flow opportunities through strategic depreciation while ensuring studies are technically sound and audit ready. Also joining us is Nina Desai, a partner in Bennett Thrasher's credits and incentives practice, focused on identifying, maximizing, and defending tax credits, including R&D incentives, within a broader integrated tax strategy. Thank you all for being back on. It's always a pleasure.
Yes.
This might be round 3.
Oh no, I was going to say, how many times have we been together?
It's been a couple, and it's always been fun. So I'm really excited to start this one. And our listeners, I'm sure, are eager to learn more. So let's start by level setting. When people hear boutique firm, it can mean different things. So how would you all define a boutique firm? And how does that really differ from a public accounting firm?
So I'll just kind of start out, and then Nina can add if she wants. But so, usually when you look at a boutique firm, they're offering like one or a couple of different services. So, maybe they're only cost segregation or they're only R&D tax credits. Or sometimes you'll get firms that offer maybe 2 or 3. But the big thing that usually they are missing is they're not full service accounting firms. So they don't offer like tax and financial audits. They're really just specifically geared toward that one function. And so you can kind of look into that, like the different people that work there. They sometimes have a tax background, and then they sometimes don't. Where I feel like in the accounting firm, you at least get like a mix of those type of people. So you'll get the specialty people and you'll get tax people. And so I do feel like the studies generally get like we'll say a more well-rounded look, where I'm not saying you wouldn't get that in the others, but I will say you're for sure going to get it in a public accounting firm.
Interesting. I didn't know that.
I think you covered all the topics. And a lot of times too, you'll see like there's differences in size. Also like regulations that the public accounting firms have to abide by versus specialty tax. Oftentimes you won't see that. So there are a couple additional nuances there. And then even to Duwayne's point, you'll see that they really have like their niche, like their niche that they focus on as well. So to Duwayne's point, sometimes it might be one specialty for a service. Sometimes it might be a multitude of them. And so that oftentimes is kind of where you'll see a big differentiator.
Interesting. Okay. I didn't know that. So yeah,
Right.
having a well-rounded experience.
Yes, absolutely.
So taking a step further, where do those differences actually show up in the work? Specifically, how does a cost segregation study from a boutique firm compare to one from a firm like Bennett Thrasher?
So, I mean, generally most people will look to, there's an audit techniques guide, right, for auditing cost segregation studies. So it kind of goes through and it says like, here's what a quality study looks like. Here's what kind of individual it should be prepared by, all of that, right? So I think one of the key maybe differentiators that I see, because we do have clients that, so let's just say we have a client that there's one entity, it's owned by 2 different partners, something like that. Maybe we do the work for one partner and then a different accountant does the other partner, right? So sometimes that other partner will bring in another firm. And so we'll end up maybe having to review the study because we're incorporating it into a tax return. And that's usually where we kind of see those differences. And so when I look at those, I try to compare it to that audit techniques guide and see how that went, right? And so I would say generally they're kind of getting there somewhat.
Hmm.
Uh, the only thing is like when you start getting into like how the study applies to the tax return, that's kind of where I feel like that stopgap kind of starts
Mm.
happening because they don't have those tax professionals. They're not seeing past tax returns and things like that. So if we look at the individuals specifically that are preparing it, it says it needs to be prepared by an individual with expertise and experience. And so it goes very much into saying like it really shouldn't just be construction for cost segregation. It really shouldn't be just tax. So I'll just kind of give you an example. If you were to take someone who I only know tax, right?
Right.
So they may go in and like they understand like land improvements are 15-year life. But at the same time, what is a land improvement as far as the return? So they may qualify something that they shouldn't, or miss something that they could have taken or something like that because maybe they don't understand that construction side as well. But
Okay.
then you take the opposite, and this is what I see in the boutique firms a lot because they don't have that tax experience always.
Hmm.
Uh, is they're excellent at construction and doing those pieces. But when you get into like a complicated tax matter, like does this study even, as far as like passive loss or, um, you know, um, a look back study where they may have made an election, seeing the past on the returns and everything. They're not seeing all of that piece. And so they're only looking at that construction piece. And I do feel like we do run the risk sometimes of getting that full integration into the return and understanding those tax positions.
Yeah, that's a really good point. Shardae, do you mind if I just add on to that as
Of
well?
course.
Probably I mean, this is certainly applicable on our R&D tax credits as well. But to Twain's point, I will say one of the big benefits too of working with an accounting firm is that we do collaborate and we try to work like as a team. So oftentimes I would say like usually the tax partner or the partner who is preparing and overseeing the return, we kind of consider them like the quarterback, and they coordinate with all the different specialty services to make sure that we're thinking about, solutions and ideas for the client holistically, as opposed to just focusing on one narrow specialty, which is I think exactly what Dwayne is touching on there. So I think that's really, really important. And that's probably one of the big benefits too of working, with a public accounting firm as opposed to just working on the specialty side. And we see that often too, where a specialty firm will come and say, oh, you can take advantage of this credit, but
Hmm.
they even utilize the credit. Or they'll talk about amending tax returns to claim credits for prior years, but they don't think about all the tax filings, the K-1s, all the impact there that they need to be considering. And so it is really nice when you collaborate. I think that's kind of the big part there is that we all need to be working together before you're making any decisions that impact your tax filing, even for planning considerations.
Thank you
I,
for adding that insight too. Yes, Dwayne.
I'm gonna pop back. Sorry.
Yeah. No problem. No,
Um,
the information
it,
is better.
when Nina was talking about before, kind of like an accounting firm, and like uh, I would say not restrictions, but like our, way of doing business and being safe and like following the rules and everything, right?
Hmm.
So I do feel like between a boutique firm and an accounting firm, sometimes I see motivations be different, right? So
Mm.
like, um, if they're going in, like, they're not really looking like I want to look at the client's full tax picture and see what I can help them with. They're
Hmm.
kind of like, I want to sell this study, right?
Got it.
So whether maybe they need it in the end, it's kind of like I feel like they're like, we're not seeing the whole tax position, so that was up to you to figure out, you know? And so they're kind of leaving that on the client and it gets blurred sometimes. Like I don't feel like they tell them like go check this out and make sure this
Hmm.
stuff is applicable to you, that your accountant agrees that it's going to fit into your tax return, correctly. I think they're really wanting to sell a study, and some of that gets muted. It's not like they're so much doing it on purpose as much as it's kind of just
Yeah,
an
but
ego
if that's
burner.
the only thing that they're working on, they can't fully see the full picture because they're not well versed in everything else. So,
Right. And I do think you'll see a difference in pricing sometimes. There are boutique firms, especially larger ones that maybe do have little, because like I said, there's a large variety of firms out there.
hmm.
Um, you can get some smaller ones where the pricing gets very low, right? And so what do you get with that? Like you don't get that full tax integration. You don't get that consulting with your tax return. You are just getting like, a piece of the
Hmm.
puzzle where it's like our study is like a full look at everything.
Right.
right? Safe, the whole bit, where that's kind of like, okay, I've paid for a piece of that process, So where does that extra cost come in and that extra risk come in from that?
Yeah, and sorry, Duwayne, I feel like we're going to keep
Yeah.
bumping
No,
back and forth
that's
here.
fine.
But to add to that too, oftentimes, like kind of like what Duwayne is saying, the business model is different. So you're the first person that you'll speak to oftentimes will be like a salesperson. They'll
Okay.
probably gift you through like the signed engagement letter. And here you're working directly with Duwayne, you're working directly with me on the R&D study or the cost seg study to really see like what are your expenses? What is your business model? What are you working on? Where is the opportunity? And I think, Duwayne, this is really appropriate to say before we even go back to the client with our results, we usually will speak to the tax partner, the person who's working on their actual tax return and be like, okay, this is what we're seeing. Are there any issues? Can they utilize the credit? Because yeah, in a perfect world, Duwayne, we could probably sell even more than we do, but
Yeah.
part of our goal was transparency and communicating with the client. Can you
Mhm.
actually benefit from this? Are there any risks that we're not thinking about with claiming this credit or taking advantage of the cost seg? Or is there any potential clawback that we need to be thinking about as you're planning for future years? And so having that big picture look and even thinking about future years and planning for just having that knowledge of what the company wants to do and what the client's looking to do in a few years is
Mhm.
really important and really helpful, I would say, with the
Yeah.
work that we do.
I'm gonna jump back in and
No, it's fine because I think I'm going to jump in here in a minute and ask a question that just popped in my head. So go ahead, Duwayne.
you know, I will say, over the past, we'll say year or something, right? On LinkedIn, I've
Mhm.
seen like a couple of people pop in and say like, and it was a negative against cost seg, right? So immediately I'm like, what?
Yeah.
Uh, and so it was kind of like, I did a cost seg and it was the worst thing ever because I sold the property quickly and I had all of this like recapture, and like just kind of different things like that. And I'm like,
Mhm.
the mistake you made was not necessarily not doing the cost seg or doing the cost seg. The mistake you made was you went to some small firm that talked you into a study because they wanted to sell a study,
Mhm.
and and it looked good to you at the time, but like you, if you were going to do that, you should have run it through your accountant, right? Or if
Mhm.
you would have gone to a public accounting firm and that would have been fully integrated, they would have asked you like, do you plan on selling this soon? Because that's one of our first questions that we ask is like, how
Mhm.
long do you plan on holding this property? And then we kind of explain why we're asking that.
Mhm.
And so I don't know that that always happens at that other end.
What would prompt someone to choose a boutique firm versus a public accounting firm? Like, what kind of decisions are they trying to make to choose one or the other? Okay. Okay. I'm just curious. I'm like, okay, so you can get a more, like full assessment of everything and a bigger picture. Why would you? I just think it would create more risk than anything. So I just wanted to kind of ask, why would someone
That's a very
choose one
good question.
versus the
And
other?
I think to Dwayne, I'll just start and then Dwayne, feel free to jump in. I think to Dwayne's point, right? Obviously, cost is a big perspective, right? But
Mhm.
I think that's also interesting too, because you'll find that a lot of the boutique firms, they charge a contingency fee. So their fee is oftentimes directly correlated with the results that they provide to their client.
Okay.
Where in public accounting, we can't charge a contingency fee. Dwayne, or I would say for most of our services, we charge a fixed fee. Obviously, you can do hourly consulting as well, but
Mhm.
that is one of the big differences. And I will say, right, when you think about contingency fees, the, you get a higher fee if you get a higher credit or if you're able to claim a higher credit for your client. And that oftentimes creates a little bit of inherent risk. And, I also just want to add here we are talking about the differences between, a public accounting firm
Mhm.
versus a specialty firm. But, Dwayne and I do work with a lot of specialty firms that we have good relationships with as well. But I just want to add that I think when it works really well is when they're collaborating with us, when we're
Got it.
collaborating together versus them just doing their job and then selling a study and then we take the results and try to
Mhm.
figure out what to do with that or if we should even use it sometimes. I have had clients that they've engaged in work to like amend several returns and we were like this is not a good idea for you, like we would not recommend this. So um I think when you collaborate well, I think that's when it works the best. I now actually forgot what the question was, Sharday. I just went off on
No, I was just curious, why would someone choose
oh
one
yeah.
versus the other? I was just curious about it. So I guess it just really depends on what they're looking for but like you said, it does make sense when you're able to partner.
On the Cossack side too, like I've seen people say like I have all this construction background because there's a certification you can get from the American Society of Cost Segregation Professionals, and
Mm-hmm.
that's a great. I feel like that is a great um, credential to have, right? Um, but it really does not. It exposes it. It teaches you kind of like what's taxed as related to cost seg at that moment, what the audit techniques guide says, right? It doesn't
Mm-hmm.
deal with this ongoing stuff, and it doesn't talk about how it fits into their tax return and that side of it, right? And
Okay.
so I do think they kind of get sold sometimes on that, like, I'm a certified, cost segregation person. And so they're like,
Mm-hmm.
oh, good to go, right? And it's like, you're still missing out on that piece. Like I think that's a selling point for some people is that certification. But
Mm-hmm.
and I'm probably jumping subjects here, but technically to represent the client before the IRS, you have to be an enrolled agent, a CPA, or an attorney, right?
Okay.
So most of those firms, not most, but a lot of those don't have that, right? They have that ASCSP designation for cost seg. And so really the only thing you could do is you can't negotiate directly with the IRS. You can't sign agreements. You can't represent for the return, the tax return itself,
Mm-hmm.
or other years. Basically, the only thing you can do is be an expert witness for technical explanations, and that's it at that point. Otherwise, someone else is handling the rest of it. Because I've had people go bid it out, and they're like, "Oh, this firm told me it's like unlimited audit protection, like as far as defending the study." And I'm like, "Well, actually, they cannot represent you before the
Mm-hmm.
IRS. Like maybe it's unlimited technical explanations, but there definitely is a difference there."
I mean, I was just going to add to that, right? Because a lot of when we are bidding for some work, sometimes that does come up where they're like, oh, well, their fee already includes, audit defense. And I'm like, yeah, but they're charging you a ton up front and you might not even keep that. Why don't you so that's also something I also like to bring up because I've had that question come up. Well, this is what they're offering. Are you doing that? I'm like, well, no, that's not included in our engagement. We
Mm-hmm.
obviously will help you and can help you should that happen. But that's a lot to pay up front for something that you're not even aware of will even
And kind
occur.
of speaking about those certifications, like a public accounting firm, you generally at most, well, all the firms I've worked for, like you cannot move to manager level without some sort of certification, right?
Mm-hmm.
So you can be a staff, you can be a senior, you can be a supervisor, but to be like a manager, senior manager, director, partner, you have to be usually an enrolled agent, a CPA, or an attorney, right?
Okay.
And so you you definitely have that piece that I'm talking about if you're dealing with someone at a public accounting firm as far as that representation.
Okay. So as companies evaluate those options, there's always a trade-off. So what are some of the risks that can come with working with a boutique firm? We kind of touched on it, but were there any other additional points that we can kind of identify?
I kind of want to piggyback off of what we said earlier, and
Okay.
I know we're kind of jumping topics, but
So,
I do want to say what Dwayne had mentioned is that he's had an experience right where, or in some cases, maybe a specialty firm will just focus on maybe one service line or selling one thing and not think about the big picture. But I
mhm,
just have an example that I could share where that happened recently. Um, is that the client was trying to work with a specialty service provider on the R&D tax credit. And so they were kind of going through the process and they made our tax partner aware of it. And so
mhm,
got me on the call to talk to them. And I said, okay, that's great, but have you thought about Section 174? And I try not to talk about throw out code sections. I know that's not exactly fun, but I just want to provide the history of that so we can
mhm,
kind of understand why this was important to share. So, as a reminder, prior to enactment of the Tax Cuts and Jobs Act, all taxpayers could immediately deduct their R&D expenses, right? Beginning with the Tax Cuts and Jobs Act in 2022, all taxpayers were then required to capitalize and amortize all their domestic R&D over 5 years and their international R&D over 15 years. And this is during that period as well. So
mhm,
it was probably for a 2024 tax filing before OB3 even came into play. And so they were working with this R&D specialty provider to get an R&D study, and they were really excited. They're like, we're going to save all this money. We're going to get these credits. And I said, that's true. You have that credit available, but do you also know about Section 174? And they had no idea that they had a compliance requirement that they have to then capitalize and amortize their domestic expenses, which would then raise their taxable income.
Mm.
And so they were shocked. And for me, that's really interesting because you can't tell one side of the coin without explaining the other side. You kind of have to explain, okay, yes, there's a credit available. Two, there's also this compliance requirement. So whether or not you claim the credit or not, you should be considering this for your tax return filing if you're saying that you're doing R&D.
Mm-hmm.
So I think sometimes if it is so narrow that you kind of maybe sometimes you're not looking at the big picture or thinking about other things. And I think that's really important to share and to think about as before you engage a provider is big picture. Are they really just going to sell you one thing or are they going to think about your overall,
Mm-hmm.
tax outlook?
I think on my side, one of the problems I see on the cost tags is like basis reconciliation. So when you let's just say you build a building, right, or you remodel one or something, like your financial books match like what you're putting in service, right? Things have
Mm-hmm.
to balance out. That's what
Of
accounting's
course.
about,
Yeah.
right? And so um, they will be kind of siloed in that they're creating this basis over here, but they're not really looking sometimes at the financials to match. And so then what happens is that study gets done. It comes in, right? Your tax return, sometimes people are down to the wire and stuff. Boom, it does not match, right? So then the client is a lot of times like stuck on a call, between the two trying to get this thing reconciled at that point. So not only does it not match, but then it makes you the middleman where you're trying to deal with that. Whereas, in our public accounting firm, if we're doing their tax return and we're doing the cost segregation study, I'm
Mm-hmm.
dealing with the tax team on that, right?
Mm-hmm.
So that's when we're talking about a lower price, like, you know, that that is so much like faster for us to be able to do that than you personally using your own time to kind of straighten this out. Like almost like, if you pay the lower price, you're probably going to pay for it in your own time as far as
Mm-hmm.
having to do this back and forth between the two firms.
And I think we know time is everything, right? And part of the reason our clients are engaging with us is because they want an experienced professional to handle it and they want to obviously they want to aid us in whatever we need, but they don't want to be involved in it. They're busy. So that's
Yeah.
kind of one of our goals
And
too,
then
is
they're
to do
like,
whatever we
I
can.
don't know how to do this. That's why I'm coming to you
That's
guys.
right, exactly. That's kind of our goal is to make their lives a little bit easier. And so
Mm-hmm.
to the extent that we can do that, it's always helpful if we can just go walk over to another person's office and be like, hey, I'm seeing this. What are you seeing? Or
Mm-hmm.
what do you think about this versus them being the middle person? And sometimes we'll see where they'll like try to connect this specialty person with the tax preparer and things don't I think that's always the best scenario, right? Where you can speak directly, but that
Mm-hmm.
oftentimes doesn't happen. So that's just one thing to keep in mind. I guess an example that I have, Duwayne, too, is um, on R&D credits, right? So if you have ownership and I'm not going to try and not to get too technical here, but if you own multiple companies, right? Sometimes you're considered part of a group. And then as part of your tax filing, you have to calculate the credit as one big group and then divvy it out amongst the entities. Well, sometimes if you don't know that this individual owns multiple companies, a majority interest in multiple entities, then you're not even calculating it the credit properly. And so then just by that alone, you're exposing yourself. And so that's an instance that we see often where I'm like, wait, what about this company? Did we factor this one in? And then you have to try to go back and make a consistency adjustment or try to fix it, or even sometimes you're even talking about amending prior year returns, which is never fun. And then sometimes the cost savings that you have at that point, you've already lost in trying to deal with fixing things. So I think you're better off paying up front for good quality product than trying to go back later and fix it.
Yeah.
Absolutely. Okay, so on the other side of that equation, what advantages do companies gain when they work with a full service public accounting firm on a cost segregation study? I know you guys touched on it a little bit. Well, Duane, you did, but
Yeah.
just
And
extra
wait,
added
listen,
bonuses.
just that full, like complete solution, from
Mm-hmm.
start to finish. So like, we'll just take it like on mine on the studies, right? When I do the benefits analysis in the beginning, I have access to the returns, right? They're in our system. So I'm looking to see like, did they have income? Like, what did their income look like? Like while I'm in there, I might glance at the rest of their fixed assets and see, are there some other opportunities out there as well?
Mm-hmm.
I can speak to the partner. If they have an odd tax situation, like I can grab a senior manager, a partner, down the hall through IM real quick, jump on a call, and we can kind of discuss the situation and work it out. And then once they move forward with the study, we're going to work with tax. We're going to make sure that it matches the financials. We're
Mm-hmm.
going to questions for tax, give it to them in the format that they need to get it into the fixed asset system quicker. And then in the end, the partner also feels more comfortable signing the return. Because they have to feel comfortable. Their signature is on the return, right?
Right.
So they have to feel comfortable with that as well. Or sometimes that outside study, they'll want to review that a little bit internally, and we may have a little bit of back and forth on that. So just that full integration. So like you're getting the best study that you can, but you're also minimizing risk, and everyone is on a comfort level, no wasted time, the whole bit.
Mhm. Where do companies tend to leave the most value on the table when their provider isn't fully integrated into their broader tax strategy?
Yeah, so I would say the big thing, and I know that I feel like the big takeaway here, and I know I keep repeating myself, but I do think it's really important and applicable, is that getting the holistic picture of the company, right? Not just where they are today, but where they
Mhm.
want to in the next few years, 5 years, 10 years. What are their goals? What are they working towards? What are some of their pain points? And when we have those conversations, in our firm with our clients, we all get together. It's not just the tax partner or
Mhm.
me as an R&D partner, Duwayne as, the cost type director. We all get together and we put our heads together to think about the best solutions that we can come up with for our clients. But that's the thing too, right? Anytime we're thinking about incentives, sometimes there's overlap incentives that clients can take. Yes, they could take X and Y, but sometimes you can't take both at the same time, or there are ordering rules that you have to keep in mind. So when we all kind of get together and think about what we think is the best, or even the best solution or the best options we can provide to our clients from a tax planning perspective, I
Mhm.
really think that's where the magic happens. And I would even say, Dwayne, I think that's kind of the secret sauce for our firm is really just the collaboration that we do and the
Mm.
excitement that we get that we
Absolutely.
have and we can help a client. We're thinking through all of the things that they're going through and where they want to be in the future. Because
Mhm.
that's actually fun for us to kind of serve as that trusted advisor when we can be part of that planning perspective and when clients are not coming to us about what happened in the past, but when they actually come with us about, hey, this is what I want to work towards, or this is really what I want to do, and getting
Mhm.
us involved at the beginning, I really think that's where I have the most fun in our job too.
We just had one of these like last Friday. We toured a facility,
Yes.
and it was kind of a combo meeting. So the tax partner went, the tax senior manager went, Nina was there, I was there, our SALT group was there,
Wow.
uh, and just listening to like what's going on with your business right now. What do you guys see as needs? Like how can we help coordinate? And then
Yeah.
just kind of like even them answering like a SALT question about like they're going into certain states or something. Like then
Mhm.
that me like, oh, they have growth coming along. And then Nina's asking questions as we're touring the facility, about like, well, how do you handle this piece? Like who signs
Right.
off on this? Do you bid this out? Do you own the rights on this? So, you know, just that whole approach and it's all there in one piece and integrated.
Well, and then even being just for that example, even just being on site, Dwayne, and you'll have to provide the specifics, but there was an example of either some piece of equipment that they had, and you were like, because it wasn't attached to the wall, it could change, or maybe it was, but because of the way that it was structured, it changed your analysis too
Wow.
about, the depreciable life on that. Was it a piece of equipment? I can't quite recall.
I think we were talking about like the manufacturing specifically that you could actually like take more uh, maybe more stuff that might otherwise be considered building,
Mhm.
as personal property, as other personal property.
Right.
Um,
So,
I was going to think too on the visit as well. Like it helps us learn each other's roles and everything too. So
Mhm.
like I can recognize R&D opportunities. I can recognize SALT opportunities. Nina can recognize opportunities for me. And we can bring those kind of things to the client where if we're working in a silo, like I just do cost seg, I don't really
Mhm.
care about this or something,
Right.
it it's just I guess the word holistic approach, to
Mhm.
like to their financial
It
situation. So
really is.
Well, and to that point too, it's, we can't all know everything. We all can't, like, I can't prepare a tax return very well, right? That's why I stay in my lane, right, with what I do. But I know the people that do, so that being part of those conversations, we kind of hear the trigger words. We know what to identify. We know because one person also isn't in every single meeting, right? So it's really important that if I hear something that would impact Dwayne, or if I hear something that would impact state and local tax, I'm like, hey, I was in this meeting. This came up. You guys probably should talk. it's really important that we serve in that role. And I think that's really where, again, having the holistic approach and working in this public accounting setting has been really beneficial for us and for our clients as well.
Mhm. And it's a great special experience that you guys are able to provide for them as well and help each other out as well, just identifying those opportunities to help them have a more holistic approach, like you all said. So it's very special. So for leaders who want to get this right from the start, what are the key questions they should be asking before engaging a provider to make sure the study or credit analysis is truly defensible and audit ready?
I mean, I'll pop in and just say on my side, I, I would ask if you were going to use one of those providers, I would
Hmm.
definitely ask like, what are the potential scenarios that would restrict me from using this, right? Like I would ask them like, yes, this sounds good,
Yeah.
but like let's not just talk about the good, let's talk about the other side, right? And
Right.
and and for I feel like sometimes the approach in that is an all good scenario, There's not the underlying like, okay, well, what else do I need to be looking for to be worried about,
Hmm.
right? Because I don't think that always gets asked.
Yeah. To Dwayne's point, I feel like I would ask about, okay, kind of to piggybacking off of that is credit utilization. Okay, you're saying I have all this credit. Can I actually use this? Like, and I don't know if they could really answer that without having the whole picture, right? So making sure that if you are engaging with a specialty provider, you at least speak to your tax advisor, and make sure that they're also willing to have a conversation, right? Want to make sure that you're thinking through that. Also, just ask about audit experience, right? How many years have you been working in this field? Kind of confirm, are they more siloed? Are they more holistic? What
Hmm.
approach they take in doing a study? Let's say, this doesn't happen too often, but it does sometimes happen where, you go through a benefits analysis and you get maybe one piece of financial information, then something comes out that, okay, no, those numbers might not have been right. What's their approach? How do they handle that? Do
Right.
they should be making adjustments to their study based on the actual numbers? But if
Hmm.
they're, unfortunately, sometimes you do see things where things aren't changed when they should be. I can give one example that, we're currently prospecting a client and they very confident that they maintain the IP rights and the financial risk of development for one of their projects. And then I said, that's great, but I would like to review a contract to just confirm that that's what the contract says.
Hmm.
Well, they reviewed the contract and they did not have any IP rights. And so I had to go back to the client and I said, this is what the contract says. Is there some other reference or some other agreement that you have in mind? But based on what I'm saying, you would not be able to qualify this project towards R&D credit. So I just, I think someone that also maybe digs in a little bit deeper sometimes. And obviously, there's only so much that you can investigate. We listen to our clients. We trust our clients, right? They're coming to us for a reason, but sometimes we do need to do a little bit more due diligence. So that would be something I would also ask about.
Nina kind of touched on like how long they've been in business, right?
Uh-huh.
So I would say like to how long have they been in business and how many people are like, if you're looking at like 1, 2 people shop or something, right? Are they going
Uh-huh.
to be around to defend that or answer questions later, right? Where Bennett Thrasher's been around a long time and it's going to be around for, a long time. And so there's really not that concern about that. Where in
Hmm.
little smaller firms, I think there is a question of like, are you going to be there, right?
Yeah.
It's a valid point. I mean, we saw that a lot when the employee retention came out. There were a lot of companies that kind of seemingly came out of the woodwork that were saying that, we're specialty practice and we'll help you claim employee retention credits. Our firm was helping with employee retention credits as well. But a lot of those firms don't exist anymore or they're not around. And now you've got clients that are dealing with IRS audits or
Uh,
their credits were denied and there's no one there to defend them. So that's a very good point, Dwayne.
and given the current landscape with increased IRS scrutiny and evolving regulations, how should businesses be thinking differently about approaching these incentives today?
I think I was going to speak on the cost, like one good bullet point, right? Is like 100% bonus depreciation sounds fantastic, right?
Hmm.
But let's just take an $800,000 item that might not qualify, right? So 100% of 800,000 that shouldn't have been qualified is 800,000 exposure. You know what I mean? So
Mhm.
I do feel like with opportunity sometimes comes increased risk, right?
Hmm.
So I think there's some great stuff that's come out as far as like the expensing with qualified production property, the 100% bonus, all these things. But at the same time, if you're taking all those deductions, like hopefully you're taking them correctly, because that is a much larger risk amount that's out there.
Mhm.
Yeah, and I'll just add to that on the R&D. Obviously, there's a research and development tax credit out there, right? That's what we're talking about, to help, incentivize companies for doing innovation in this country. And then I just want to kind of touch base on OB3 as well. Right now, you can immediately deduct your R&D expenses, but a big part of that is that you also need to make sure you're documenting it, right? So it sounds really great in theory to claim credits, and I always say this: if you're doing the work, you should get a credit for it. There's no doubt about that. Let's dig in, let's investigate, let's explore that opportunity. That's why these credits and incentives are put into place. It's to help companies, right? We want to keep everyone in business. We want to help the country. But all that to say is you want to make sure you're documenting your efforts, right? Because you can claim everything, and then if there's no documentation that substantiates your efforts, if it comes under exam, it can be very problematic. So document it in real time.
Document.
Yes, pretty much.
Duwayne, I thought you were going to say something else, Duwayne.
No.
I'm quiet. You've been talking a lot.
There's lots of exciting stuff out there. There's lots of opportunity. It's just doing it right, and that making sure that you're covered, and that you have someone that's going to stand by you, like going forward, and someone that's going to look out for your interests, that knows your whole business. So.
Well, thank you, Nina. Thank you, Duwayne. This was a great conversation, and it gave a broader perspective on what a company should be thinking about and how do they go about doing these things and making important choices and documenting. And great timing. And choosing the right team to help them through any process. So I really appreciate it. I hope I see you again on another conversation. And you guys, thank you. And you guys have a great rest of the day.
You as well. Thank you.
Thank you. That wraps up today's conversation with Duwayne Sibley and Nina Desai. If there's one takeaway, it's this. When it comes to cost segregation and tax credits, it's not just about identifying the opportunity. It's about how the opportunity is built, supported, and integrated into your broader tax strategy. The difference between checking the box and getting it right can have a lasting impact, not just on value, but on risk. Thanks for tuning in to Beyond the Ledger. For more insights and expert perspectives, visit btcpa.net and explore our latest resources. And don't forget to like, follow, and subscribe so you don't miss future conversations. Until next time, I'm Shardae Layfield, and we'll see you on the next episode.